and welcome to CommBank View, Economics and Markets, where we unpack key issues each week with expert voices among CommBank's economists and strategists. My name is Mandy Drury, and I'm always delighted to be your weekly host. For this week, I'm joined by Luke Yeaman, Chief Economist at CommBank, and Adam Donaldson, Head of Market Strategy and Rates Research. So welcome, gentlemen. Great to have you for this really special edition. So, Luke, let me get to you first of all, because Treasurer Jim Chalmers has now handed down Labor's fifth federal budget, which he is touting as the most significant of the 21st century, promoting intergenerational equity. He had a big and multi-pronged task at hand to support those struggling with the cost of living, to make changes to tax, and to improve local resilience, all without making already high inflation even worse. That's a lot to achieve, isn't it? What do you think he did? Did he achieve it?
Thanks, Mandy. It's great to be here. Look, you're dead right. It's been a really big budget preparation and a big budget night. And we've seen a lot of anticipation about big reform and a lot of concern on the side of cost of living and resilience, as you said. So in terms of how he went on the night, our view is they succeeded in some areas, and in other areas they probably could have done a little more or maybe just failed to shift the dial. And at a high level, what I'd say is the big positive of the night was a much more strong, solid, credible path back to surplus. The long-term budget position does lift as a result of this budget, which is off the back of some big savings to the National Disability Insurance Scheme and the new tax measures that we'll talk a lot more about today around housing. So I think that was a really strong positive. Other than that, when you look at inflation, did this budget help fight inflation or did it do damage? I think that's an area where there might be a missed opportunity. Not a lot of damage done, but perhaps a missed opportunity. And again, I'm sure we'll talk a bit more about that. And on the reform side, we saw some good measures in this budget around productivity, but again, probably more could have been done, and maybe we need to wait for future budgets for that. So overall on the night, I'd say some good things in there and some good steps around long-term budget repair, but perhaps some other areas where more could have been done.
We'll unpack all of those issues in a moment, Luke, but can you give us just sort of a high-level, quick rundown of the fiscal aggregates of the numbers at hand?
Yeah, so in the current budget year, in the budget year 2026-2027, we saw a deficit. We are still staying in deficit for at least the next 3 to 4 years. The deficit in this fiscal year is going to be $31.5 billion. That was a small improvement on what we'd expected from the last budget update in December, about $2 to $3 billion improvement. So a small benefit there. But overall, we're staying in deficit. We saw some big improvements in aggregate over the first 4 years of the budget. The UCB, the underlying cash balance, which is the key measure people look at in terms of the bottom line, has improved by about $45 billion over those 4 years. But the big story of the budget is there hasn't been a big improvement in the first 3 years. Overall, the numbers there are fairly modest. But once you go into that fourth year and then beyond, you start to see some bigger improvements. By the end of the decade, the underlying cash balance has improved by about 1.3 percentage points overall, and we've seen gross debt come down quite sharply too.
So, Luke, it seems like you're saying that some of the heavy lifting with regards to the long-term budget trajectory is going to be over the next decade, but how much of the savings we're expecting predicated on some lower spending when it comes to the NDIS?
Yeah, it's a great point, Mandy, and this is a really critical thing for people watching the budget to keep an eye on. The NDIS has been the biggest cost pressure in the federal budget for at least the last 4, 5, 6 years. It's been growing very strongly and causing some big blowouts in the budget estimates on a year-by-year basis. And we saw that again this year. The current year estimates blew out partly because of the NDIS increasing its spending. So what the government has said is they want to get serious, they want to get tough, and they want to bring the NDIS spending down. That's a good thing for the future sustainability of the scheme. But the numbers are very ambitious. And so you can see they're now forecasting the scheme has been growing at about 10% every year on year in terms of scheme costs. This year, that was the case. Next year, they say that they're going to start bringing it down. And over the next 4 years, they think it can average 2% over those 4 years in total before reverting back to 5%. That's now been baked into the budget bottom line. If they can't deliver that, then that's going to punch a hole in the budget estimates and the budget improvement that we described. So for example, if it was more like 5% growth, that could see about $70 billion go back onto the bottom line over the decade. So there's a big risk factor there. And this scheme has had huge momentum, and it's not going to be easy to drive this change. To get back down to 2% average growth over the next 4 years, it's going to require cooperation from the state governments, who are very worried about cost shifting money from the federal to the state budget. and it's going to require a lot of community support, particularly from the disability community. And that's not going to be easy. So I think we see a high risk that some of those savings won't be delivered, particularly in the next 2 to 3 years. And that could then have cascading effects back through the budget over time. I hope I'm wrong. I hope that they do deliver those savings, and the government seems very serious about doing it. But just in practice, it's going to be quite difficult.
You mentioned that this budget doesn't really help the RBA out. Did it actually add to inflation woes, and has it changed your view on interest rates?
No, this was one of the big tests of the budget. There was a lot of concern about high inflation and the Reserve Bank taking a more aggressive stance on monetary policy. And the question was, would this help the RBA? Would it be neutral? Or would it do damage and make the RBA's job harder? And overall, we would say this hasn't shifted the dial as for the RBA. When the RBA is sitting down looking at their next set of forecasts, we don't think the budget will be playing a big role in that. So it hasn't, I think, surprised the RBA, and it hasn't shifted their view overall. And we haven't shifted our view on the path of the cash rate from here. We still expect rates to be on hold for some time. But as I said at the start, it looks to us like something of a missed opportunity, because if you look in the current fiscal year 2020 or coming fiscal year 2026-27, that's when the fight against inflation is going to be at its hardest and its hottest. And so that's when the RBA needs the most help and needs fiscal policy working with it, not against it. And in that year, as I said, there hasn't been a big change to the overall deficit, but the government spent around $8 billion in new money in that year. And when you look at the net impact of policy decisions in that year, it's about $6.5 billion deterioration. So the government is actively putting money into the economy during that year. And the deficit, which if you compare 2025-26 to 2026-27, it does widen marginally. So the conclusion is we have said we see this budget overall as being broadly neutral to mildly expansionary. And there was an opportunity, if they'd spent a bit less, to create some more headroom for the RBA, so that if they do find themselves in a tougher inflation fight over the next few months, that would have created a little more headroom and flexibility and taken away the likelihood of further rate hikes. They didn't do that, but they didn't do a lot of harm either.
You mentioned, Luke, that some of the most talked about and controversial topics in the lead up to this budget were tax changes relating to housing, the negative gearing and CGT. In other words, sacred cows in Australia. What are the changes, and what do you think they're going to do to the housing market, to prices, to rental prices and affordability, given as many as 45% of all landlords are negatively geared, according to ATO data?
Yeah, this is the big news of the night. There's going to be a lot of discussion over the next few weeks around what this means for investors. There's no doubt. And as you say, these changes have been talked about for many years, but have never really been delivered. And the government has finally taken the step and delivered these changes. So at a high level, what this means is that negative gearing has been scrapped from 1 July 2027 for all established investor housing. New housing has been carved out, and existing investors have been grandfathered. They're the two key extra additions to the change. On the capital gains tax discount, previously you were able to receive a flat 50% discount on capital gains across all asset classes. Now that's been replaced with a model of indexation, which was what was in place prior to 1999. But what it means essentially is you no longer receive a flat 50% discount. You are essentially taxed on the real capital gain of your assets only. So they're the two big changes that we see overall. It's going to be very complex. I think a lot of people will be going to their tax advisor or to their accountant over the next few weeks trying to figure out what this means for them. And there is a lot of complexity in the changes. But at a high level, negative gearing is probably where the biggest impact is on the housing market as we see it. There's no doubt that when you remove the option of negatively gearing for an investor, particularly an investor who is highly leveraged, who has a low rental yield, for those people, this represents an upfront increase in the cost of servicing that investment. And we've done some numbers around this, and a lot depends on the individual investor and what their circumstances are. But if you took someone who had a $1 million home as an investment property, still had $800,000 left on that loan, put in some assumptions around their financing costs, it could be equivalent to a 100 to 125 basis point increase in interest rates for them. So we're talking about a serious hit to the overall upfront cost of servicing that investment, and that will have an impact on the investor side of the market. When we look at it together, we would say that change might drive house prices down by about 3% over the next few years, but obviously the effects in the investor segment of the market and townhouses and apartments could be stronger than that. If you look at capital gains tax, it's a little more tricky because it does depend on what inflation does and it depends on what asset values do over time. We've had a bit of a look at this from an asset class perspective just to see how different investors will be affected? I know, Adam, that's something your team's looked at closely.
Yeah, that's right. So if we take one step back and think about the structure of the Australian tax system, it's typically favoured assets that grow quickly or have those capital gains much more than it has income assets like deposits or fixed income, where you tend to get taxed at your marginal tax rate. And that's been a real disincentive for that more stable type of investment. What this change is doing is effectively starting to level that playing field to a degree, not in a way that makes the fixed income side more attractive in its own right, but on a relative basis, some of the money that might have flowed into the more speculative areas of the market, think tech stocks, think mining, small mining companies, where you effectively have investors taking a punt on what the big returns might be in the future in capital. The change in tax treatment could have an impact on that risk assessment that people make in terms of putting their money there. So it starts to slightly even up the playing field. Clearly, overall, housing is set back a little bit, but then there's also the change within the investor class, and it's something that probably favours the so-called value stocks as opposed to growth stocks, and favours fixed income a little more than those assets as well.
Absolutely. And we'll talk more about the fixed income market with you in detail, Adam. But just a really simple question. Do you think these changes were necessary, given that the government promised not to touch CGT or negative gearing at the last election? So how did they justify making the changes now in 2026?
Yeah, it's a complex set of reforms, and there's a few different ways of looking at it. So on the one hand, as I mentioned earlier, there's a big revenue benefit of this. So if the goal is to improve the long-term budget position, this is one way to do it. And it has led to about $77 billion in new revenue coming into the budget over the next 10 years, according to the government's estimates. So that's a major change. So if that's your goal, then I guess that's a success. And primarily, the people that benefit most from these tax concessions in the past have been relatively high-income individuals. That's not entirely the case. There are plenty of people out there in Australia who have maybe one investment property and wouldn't consider themselves to be well off. But in aggregate, when you look at the benefits that flow from these tax concessions, they're at the upper end. So the government's argument would be this is helping to repair the long-term structural budget position, and primarily it's improving equity in the tax system, driving more of the benefits away from high-income earners towards low-income earners. The other big part that the government's pushing on is they're hoping that this is going to drive a shift in the composition of the housing market away from investors towards owners and first home buyers. And that's where I think they're hoping to see some success. It's not going to solve the housing affordability challenges in Australia. That's got to come back to supply at the end of the day. But they're arguing this will help at the margin to take a bit of heat out of investor demand and create some room for first home buyers to come in. We think we will see that to an extent, but it's going to be quite marginal. And there's a lot of complexity here in how this will play out in practice, depending on how the market responds. Do people still see housing as a viable asset class going forward and expect strong capital gains? What does it do to supply? I mentioned that the government has carved out new homes. So we could actually see some investors who previously invested in established housing now move and look towards new builds, supporting things like pre-sales for new apartment buildings, and that might see supply lift a little in the future. So there's a range of cross-cutting effects here, but in our general view, we would see house prices coming off a little, rents rising a little, but fairly modest shifts in that area, and then some improvement for owner occupiers and first home buyers to come into the market. But I wanted to say, Mandy, I think a really important point here is the modelling we've done looks at the relative value of different assets. In practice, the housing market is always driven by sentiment, and we're going to see over the next few weeks how the Australian community responds. And so when I talked about an overall fall of about 3% driven by these changes in house prices nationally over the next few years, there is a serious risk that it could be more than that, and we could see some real volatility in the short term and sharper falls if investors start to look away from housing as an asset class in the short term.
You're absolutely right. Sentiment is an incredibly powerful influence over both markets and economies. Sorry, Adam, you were going to say something?
Well, I was going to say, and I guess that is something that you would also want to think about when assessing that RBA part of the equation and the potential reaction to the budget. If there are larger effects on the housing market near term, then inevitably that starts to make them a little more concerned about the economic outlook as well.
Luke, what about broader reforms to personal and corporate tax? Do we see any big bang reforms that will shift the dial on productivity and investment, or are they maybe saving some dry powder for future budgets, such as the lead up to an election?
Yeah, we'd been watching this really closely because the government had talked quite a bit about corporate tax reform in the lead up to the budget. We had an economic and productivity roundtable the Treasurer held shortly after the election. The Productivity Commission had been suggesting changes to corporate tax, including a cash flow tax. So there had been quite a bit of discussion around this, but on the night, we just didn't see those big changes in the budget. Now, it could be that the pressures that came into the budget late around the war in Iran, so more spending on fuel security, more spending on defence. There's a range of other pressures that have kicked into the system. The fuel excise cut, for example. I wouldn't be surprised if those extra spending pressures meant that there just wasn't enough money left over to be able to make some of the bigger changes to corporate tax. The question is, will we see it in future? And I'm still holding out hope that we will see some bigger changes ahead of the next election because, as I said, the long-term budget position has improved quite materially, and that does create something of a war chest that the government could use to fund either broader personal income tax changes or corporate tax changes at the next election. There are some measures in here. Australians would be aware there's a new $250 working tax offset for all Australians. There's a $1,000 instant deduction now rather than having to claim work expenses and fill in receipts. Everyone can claim $1,000 straight off the bat without having to do that paperwork. So there's a few changes in there around personal tax, and there is an extension of the instant asset write-off for small businesses and also some provisions around loss carryback. So there's some small changes in here for corporate and personal tax, but we didn't see the big bang reform that might have been talked about at the Productivity Roundtable.
And you mentioned fuel security, which speaks to economic resilience in Australia. Do you think that the government did enough in taking steps to improve our protection from shocks such as that?
Yeah, so the government invested about $14.8 billion, I believe, on the night into new fuel security, aimed mostly at fuel, whether that's jet fuel, petrol, diesel, but also some work around fertiliser, which has been a weak spot and an exposure point for the economy during this crisis. So they've put some money into it, and that's significant money. Putting $15 billion in is a lot. Interestingly, in this space, you don't necessarily get a lot of bang for your buck with the dollars that you put in. So Australia started this crisis, as many Australians would know, with about 40 days worth, 35 to 40 days worth of fuel supplies. Most other countries have much more than that. Most other countries have 100 days supply or more. And the IEA recommendation, the official recommendation to countries, is that they hold 90 days. What that extra $14.8 billion buys us is about a 10-day boost. So the government's targeting 50 days as the minimum across those different fuel categories. That's a start. It's a good start. It's an important step to take. But I would have expected maybe a little more to come into that space given the pressures we're seeing in the economy today and the risks we see globally. So I think there's probably more investment coming, whether it's defence generally or whether it's fuel security. I wouldn't be at all surprised to see over the next few budgets that more has to be done in that area.
So Adam, let me get to you again, because Luke has been saying that one of the biggest changes in the budget is to the long-term budget trajectory and gross debt. What does that improvement in the long-term fiscal outlook mean for bond issuance and our AAA credit rating?
Yeah, so we think it certainly helps to shore up the outlook for the credit rating. There was a lot of ambition and expectation coming into the budget because of the pre-announcements that we had seen. And so everybody knew there was structural reform coming. So expectations were high. I think it's fair to say on budget night, perhaps the budget didn't quite live up to all of those expectations for some of the reasons that Luke mentioned. But when you take a step back and you do a comparison of how the budget looks today versus, say, a year ago, the annual issuance numbers for government debt are quite a bit lower, basically from 150 billion a year down to 125 billion. And the debt to GDP profile, yes, it lifts a little bit in the next 2 years, but to a much lower peak than was previously forecast, and then it falls away very sharply. And in the scheme of things, when investors are looking at a place like Australia and rating agencies are considering it, it's that long-term sustainability that they're most interested in. And that story is a really good one. It's quite different to the impression you get when you look at almost every other advanced economy. So right now in the UK, there's political turbulence. There's a lot of concern about what that's going to mean for the fiscal backdrop. In Japan, similar, numbers are blowing out. In the US, there's an ongoing debate about the lack of fiscal sustainability. That simply doesn't apply in Australia. And so we think that that is a really good backdrop, and that the budget has helped cement Australia as a very popular investment destination because of that.
Okay, so you're saying that it improves Australia's relative attractiveness as an investment destination at a time of global uncertainty such as we're seeing at the moment. Does this spur issuance, do you think, into Aussie dollars, and therefore put a little more gloss on the trend that you've been talking about for some time now, Adam, and that's Aussie dollarization?
Yeah, that's one of our favourite words. And absolutely, we think that it's this fiscal story that is a fundamental underpinning of that. It's not the only story. When we look at Australia's broad national liabilities relative to GDP, they're about half what they were 10 years ago. That's a fantastic story. It's partly driven by the massive growth in superannuation savings in Australia. Those things are central tenets of what people look at when they think about sustainability. Probably the other one is housing debt to income, and those ratios have been drifting a bit lower, whereas in the past, 10 or 15 years ago, that's something that people would have looked at Australia and said, number one risk factor. All of these things have effectively been de-risked over time, and it means that, the popularity as an investment destination is high, and we've got a huge increase that's unfolding in terms of the share of foreign ownership of Aussie debt as a result. Not just these Commonwealth bonds we've been talking about, but the states, the corporates, the bank debt that's issued. More of it's being issued in Aussie dollars as a result of that demand. More is being bought by overseas, and so it's making it a very competitive capital market and a much more liquid and efficient one. And ultimately, that delivers benefits for the nation. If you're thinking about options when you're wanting to raise capital, it makes Australia an attractive place to do that. And so there are payoffs for the economy that should end up coming through as part of that resilience.
I'd like to tease out something you touched upon earlier, Adam, and it was bouncing off something that Luke said, that the budget is slightly stimulatory and doesn't help the RBA, particularly in its battle against inflation. But you're saying it's still supportive for the fixed income market.
Yeah, that's right. So the way we look at it, yes, clearly there's some risk that the RBA does need to tighten rates a little bit further. At the moment, the money markets are pricing about 1.5 rate cuts in Australia. If the RBA were to deliver again, that very front of the curve, maybe it would adjust a little bit higher because of that. But by and large, the tightening cycle is priced. If it were to be that the RBA didn't move, then ultimately, actually, you'd see quite a bit of strength and appetite come through in Australia. So it's got some inbuilt protection there. But the further out we go, where issues like the volume of bond issuance, the knowledge that policymakers are focused on competition, efficiency, keeping inflation low, those central tenets that people value, I think that helps with the long-term part of the market. One sort of contrast we could make at the moment, just on the day, basically, where Kevin Walsh has been appointed Fed chairman, is, there's certain reservations about whether he's going to be pursuing a traditional Federal Reserve approach to managing the economy and focus primarily on keeping inflation down, or will they make decisions to lower interest rates for political reasons? We suspect the former, we hope the former, but you don't quite know. Whereas there's other issues in various countries with their focus on policy that has shifted. Part of what Luke was talking about with regard to resilience, we see some of those pressures here, the oil build-up and the defence spend and things like that are necessary. But the further permutations of that aren't the case. Our structures remain very solid. And so if you're wanting to put money to work for 10 or 30 years, they're the things that really matter to you. And so that story looks, I think, very, very solid for Australia. Mm-hmm.
Adam, just very briefly, maybe you can tell us about what's happening at the state and territory level, given that we've seen budgets in WA and Victoria recently, all with very different trajectories. How do you see those budgets having an implication for their funding tasks?
Well, of course, WA continues to live off the rivers of gold of commodity royalties and a fairly healthy GST allocation. Victoria, more of a struggle, and we're seeing some differences in their individual performances there. In both cases, we saw a desire to provide cost of living relief and arguably, not full adherence to the kind of fiscal discipline that you would like to see in this inflationary environment that we have. The rating agencies make noise about that as well. But the numbers weren't huge, and one common denominator for both was that the 25-26 year is better than expected, and so there's a little bit of money to play with there. What we have done is a fair bit of modelling work looking at state debt to GSP or GDP ratios, and that's an important driver for state government debt. What we're seeing is that those ratios are flattening out, and so broadly it's a fairly neutral, maybe slightly positive story on that front.
And Luke, one final question to you, because one of the biggest complaints for businesses, small and large and across sectors, is the need to reduce red tape, things like compliance costs and overlapping state and federal regulations. Did we see any measures that aim to cut that red tape and therefore, by default, help lift productivity?
Yeah, there was a productivity package in the budget that had a long series of measures that were all aimed one way or another at trying to cut through some of that red and green tape. They're all good things to do in their own right. There was a particular focus on the financial sector and how to streamline regulation there. There was a continued focus on project approvals. So there's some good things there. But one of the lessons we've seen over the past few decades in Australia is we don't have those really big levers that you can pull. It's hard yards in this space for governments. They have to continually look at the regulatory burden and look for ways to try and trim and tighten that up. But there isn't really a big stick that you can just wave through and clear that away. So I think when we look at it in aggregate, I don't expect any of those changes to fundamentally shift the productivity outlook in Australia or unlock a large amount of new investment. But they're good things to do, and we need to do more. We can't do enough in terms of particularly project approvals. That's so critical to what the Australian economy needs over the next 3 to 5 years. There's a huge amount of investment coming into the Australian economy and opportunity there, including around data centres, around net zero, where we need around housing, infrastructure. All of it involves building big things and trying to build them quickly and efficiently. So the more we can do in that area, the better. So they've made some good steps, but there is more we can do.
There's always more we can do, right? As if only we had a magic wand. Of course, it takes a lot of vision and some big, bold decisions as well. So both of you, Luke and Adam, thank you so much for passing through the budget. Of course, there are many more things that we could discuss, but given our time constraints, that's all we have time for today. But thank you, Luke and Adam.
Thank you.
Thank you.
Before we let you go, let's do a look at the week ahead now with Samara Hammoud. Hi there, Samara. It's really interesting the way, you look at the United States and we're continually hitting record highs at the stock market there. And yet, the sentiment on the ground feels that the prospects for an imminent peace deal between Iran and the US are fading.
Yeah, Mandy, that's exactly right. Markets are starting to become a bit more doubtful that there will be a deal reached between the US and Iran in the near term, and talks do appear to have stalled. President Trump recently did come out and say that the ceasefire deal is on massive life support, and so that kind of fueled some of those concerns. But despite that, we do think that President Trump will want to preserve the ceasefire deal just because the economic and political costs of the war are really starting to mount. So our base case does remain one of a de-escalation. So we expect a deal to be reached between the US and Iran by the end of the month or shortly thereafter. But of course, there is a material risk that we may see a re-escalation in tensions, just as the US and Iran try and increase their leverage in negotiations.
Indeed, it does seem quite unpredictable. You were talking about President Trump, which brings me to the big Trump-President Xi summit in China.
Yeah, exactly. So President Trump and President Xi are meeting in Beijing, and that actually started today. And that is the first of the two summits that are expected to take place this year. And our expectation here is that the two presidents will want to extend the trade truce and that they will want to maintain the status quo.
Turning to Australia, we have had the latest wage price data. What's it told us?
Yeah, so that wage price index data, it did print in line with consensus expectations at 0.8% for the first quarter of this year. So the broader story does largely stay unchanged. The Australian labour market is broadly in a steady state, but we do think that it is still a little bit too tight for the Reserve Bank of Australia's comfort.
And last but certainly not least, Samara, we've had US CPI and PPI for April. What did it tell us about inflation in the US and the outlook for the Federal Reserve?
Yeah, so just starting with the US Consumer Price Index for April, that did come in stronger than expected. So headline CPI rose by 0.6% over the month, while core CPI, that increased by 0.4%. So both of those are really solid numbers. And those higher energy prices were reflected in quite solid gains across fuel prices, airfares, and food. And following that CPI release, markets did actually increase expectations for a US Federal Reserve rate hike in December of this year. And in terms of the PPI, that actually also came in stronger than expected. So headline PPI rose by a very, very strong 1.4% over the month. And so that suggests that price pressures are broader than just fuel price increases, and we're starting to see those price gains in input costs as well.
Wonderful. Thank you so much for the rundown, Samara Hammoud. And thank you very much for listening or tuning in today. Make sure that you follow CommBank View for your weekly analysis on what is shaping the markets and economies. My name is Mandy Drury, and thank you today for your time.